Major funding for these programs is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Bank of America, Murray Hill Properties, SJP Properties, Greenberg Traurig LLP. Additional funding is provided by grants from Antares Investment Partners, Arbor Realty Trust, Athena Group, BRT Realty Trust, Burden LLP, C.B. Richard Ellis, City Habitats, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, Jackson Development Group, Meridian Capital Group, McSam Hotel Group, Newmark Knight Frank, Moynihan Organization, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, Stonehenge Partners, Studley, Sutphin Properties, the Wyckoff Organization, Extreme Construction and Deconstruction.
Hello, my name is Michael Stoll, host of the Stoller Report, Real Estate Trends in the Tri-State Region. There is a little credit crisis these days. There's turmoil in the credit markets, but there is money for real estate. That's what I hear. And I've assembled three guys who really are the kings on real estate, on financing, who are going to tell us if there's money, what's happening, why this has changed, and so on. I'd like to introduce David Mazugian, President and Managing Director, ING Real Estate Finance US.
Correct.
Doug Harmon, Managing Director of RBS Greenwich Capital. And last but not least, Joe Ficalora, Chairman, President, and CEO of New York Community Bank. Thank you for all being here. So, we were saying prior to the show, Mr. Harmon, that there's an adjustment. There's something, the market has changed. What's happened? So much money was available. I mean,
absolutely. I mean, if you went back and we rolled back the clock 9 months, I would say it was a borrower's market. That has completely changed. The balance of power, or the leverage, so to speak, between the borrower and the lender has now shifted to the lender's side.
Do we blame this? Can we blame this on the alleged subprime crisis? Because subprime doesn't have an effect in reality to commercial lending, because you guys are commercial lenders.
Commercial lenders.
Okay, you're commercial lenders. You don't lend to the home. You may lend to rental apartments, but you don't lend to finance somebody's apartment. Did the subprime crisis, or what happened? What happened to the system?
I think the system, the underwriting standards became lax, and it was clearly evident first with the subprime market. But once we saw the effect in the subprime market, it sort of infected the securitization market. I think investors saw what happened in subprime. The rating agencies woke up and they started looking at how underwriting standards had deteriorated in the CMBS market. And so it started, we saw the first evidence in January on subprime, and come July and August, it really had affected the securitization market as well.
I think also coupled with that was if you look back at when Moody's was the first to kind of throw the yellow flag into the field about the underwriting standards for the CMBS market. And that had an implication.
Okay, for my audience, well. That's a collateralized mortgage bank securities. You know, we try to do it not like Fox TV, but like Stoller on that. But you never were in this CMBS. I mean, you started. You're a hardworking guy. You started as a teller. I mean, come on. And how big is the bank?
30 billion.
30 billion.
31.
Okay, not a bad. I mean, but you've been lending through. But were you guys a little lax also, maybe?
Well, I think what we're really looking at here is an elongated positive credit cycle, running from the last cycle turn to this cycle turn, which now has begun. It's longer than normal. The excesses in this cycle are far beyond the prior cycle. So the amount of correction that is likely to occur during this cycle of correction could very well be worse than what happened in the period 87 through 92. And if that in fact comes to be, and in order for that not to come to be, there would have to be a confluence of positive factors that could offset what is already in place. And the excesses that are in place are extreme, not just because values are extremely high, but also because lending standards were extremely low. And I guess what you were talking about, subprime, is merely indicative of how bad the environment has actually become. Is it going to impact all lenders? And I think we were talking about this earlier. We're all going to see a dramatic change in risk and reward. We're all going to see the few lenders that remain in the market, as in fact losses pile up, will be asking for more in order to be in the market. And the breakage that is occurring today at the top is extraordinary. I mean, we're talking about the largest players are losing in big dollar volume first. It's not individual foreclosures, it's package pools of bad product and the revaluing of these large package pools.
But what happens, you know, I was saying prior to the show, since the banks had become lax in many situations, and, you know, in a similar manner that they're talking in 2008, there is going to be a lot of residential mortgages coming up for renewal, for repricing. What happens to that that loan that you may have done that had interest only, no amortization, and, you know, sometimes we were hoping that the revenues would go up to that certain level. The office market, you know, Barton Gale was with me today. He said, hey, you can't get 8% compounded rent increases. Office rents are not going to go up as much as they were. You know, certain apartment people, and I know you've seen it, and I know you've seen it, and are projecting, you know, $80 rents for certain things. You know, it's not reality of this. What happens when some of these loans, let's say a loan that maybe you have on an apartment house or an office building, and they come over and they say, yeah, pay me my $30 million, pay me my $100 million. What's going to happen to the situation? Now,
well, I think there'll be a discussion. I think you could say, well, the loan's due, you have to pay us, and then there's reality, which is, okay, we have to sit down and have a conversation. But I think it's important to distinguish between sort of individual mortgages that are coming due next year that are being reset in terms of the interest rate versus sort of the space that we're in.
No, but I'm talking the commercial mortgage. I'm not talking. I'm talking. Let's take a situation. You know, somebody may have you sold an office building, and the office building you were contemplating, maybe it was a year ago, that you would be renting it up because of the market was so good. We have layoffs. Bear Stearns lays off 10% of their staff. There are other people who are going to be laying off. I was with the head of Cushman and Wakefield. He said leasing is down. He said we just lost a major lease, which was a $2.5 million commission. People aren't going to be leasing as much. So somebody where you thought that the rents were going to go up from $30 to $50 or $60, they're not going up there. And that was in your projection. That borrower comes to you. What's going to happen?
I think there'll be a conversation, and I think it depends on what's the quality of the borrower, how well capitalized is that borrower, how well capitalized is that sponsor, what is the breadth of their experience? Do they have the wherewithal to get through a protracted cycle if it does become like the late 80s, early 90s? I mean, I think Joe raised some interesting questions about sort of will it get as bad as it did then. I'm not sure. I think the difference that I'm seeing between then and now is while things may be slowing some bit, the real estate fundamentals, with the exception of the for sale housing market, is still relatively resilient. We're still seeing growth in the office sector, the retail sector, but clearly if people are losing their homes, clearly that affects purchasing power. People aren't going to the mall as much.
Let's look at this. I don't know if you're in the hotel lending. That was the topic of my article. There are hotels, and a hotel is basically every day you have to get new customers.
Absolutely.
They have new customers. Right now, if you walk on Fifth Avenue, you walk past the hotels, half of it is foreigners. I mean, you can't get a hotel room. What happens if the foreigners stop going to the hotels? And what happens on these hotels who have this unbelievable number that they think hotels in downtown Brooklyn are going to get $300 a night on Duffield Street? Or I was on 4th Avenue yesterday past a hotel called Le Bleu, and the Sam Chang 22 hotels on 39th Street. What happens to this? I mean, this is operating businesses. What's going to happen? It's like a restaurant. One of the hardest things that I remember as a lender, I never wanted to lend to restaurants. I mean,
well, I think it's a good question, and if you sort of look at where cap rates have gone over the past few years, I think the market has forgotten that hotels really are an operating business. And cap rates today, although I think they're starting to edge up a bit, cap rates for hotels are at historic lows and haven't really remembered that it's an operating business. And if the foreigners stop coming in,
but now let's take the condo market. Let's look at something that everyone here has had some involvement with, and let's not take that luxury market, which you've had some experience in, which you've done very well. Let's take those. Right now you walk around the 5 boroughs, there are more cranes in the ground because everybody remembers June 30th, there are no more tax abatements, the thing called 421As. So what happens? We have all of this apartments coming on the market. One, we have a recession.
Do you think we have a recession?
I heard today. I said yes. You have 2 bad quarters. You have a recession. So you have a recession. The stock market's crazy. People are scared. Unfortunately, people read some people in the press, like the New York Times today, which was, if you want to kill it, just allow somebody who knows nothing about the business write an article. What happens to the condos? What happens to the condos that you've financed, or even the condo conversions that have happened?
Yeah, I would agree with your view that there's inarguably less consumer confidence than there was 6-9 months ago, and so I think that again, those sponsors that are best capitalized, that are providing the best product, will be those that are successful. It's like everything else. When there's fear in the market, there's always a flight to quality. I think that the best projects with the best sponsors will get built and work. Those that are less well capitalized at inferior positions will not work.
Everybody loves Williamsburg. All of a sudden, everybody loves Williamsburg. If you don't take the O train, this is the world of Williamsburg. There's a lot of product coming on board. I mean, you got the Edge, 1,000 units. You have Toll Brothers. These yuppies. This is $900. It's $1,000. What happens on these units? What's going to happen in a place that if there's this glut? I mean, George Klein has this big thing, but which may never happen in Greenpoint. But there are so many things. Williamsburg, Long Island City, downtown Brooklyn. We won't even talk about Staten Island. You bought a bank there, so it doesn't matter. But
well, a lot. Michael, a lot of these projects were built in locations that, I think, if the market continues to be strong and there's ebullience, they'll be sold. And there's all these junior associates and associates and vice presidents on Wall Street who can afford these apartments. But if the economy turns and there is a recession, what gets hit first? Fringe locations.
I'm going to say something. RBS Greenwich Capital. I don't know if you've had the layoffs, but some of your colleagues in other businesses, Wachovia, Bear Stearns, have had the layoffs. These kids who've worked for you sometimes are under this misconception of what they're worth and of what their earnings are, and they then they bought this under the conception, I got my base, I got my bonus, I got all this crap. They can't pay it. I mean, they can't get a job.
But we all do that, even the grown-ups.
Right. So what do we do? I mean, I don't want to paint a picture, but I want to give to my audience the reality of what's happening today. And from what I hear, the reality is we're coming to a flight to quality. we don't want to lend to somebody, it's interesting. My wife sometimes says, "Why didn't we buy?" I said, everybody, wants to own a property. They say, "I want to buy that 6-story brown, that building. I'm going to convert it. I'm going to own it." But they don't realize that oil goes up, especially, it's $90, $94. What happens to the inexperience?
I think what happens is what has happened in the past. We're not looking at something unique here, accepting that the degree may be greater than it was in the past. I think it would be foolish for us not to recognize that real estate is cyclical and the credit cycle is cyclical. And we've gone through an elongated positive cycle, and we inevitably will go through a corrective cycle. The corrective cycle could take a number of years. And the reality is that many of the things that happened in the period 87 through 92 will happen now. In some cases, it'll be worse now, and in some cases, it'll happen more rapidly now. So when you look at an evolving cycle, it normally takes a longer period of time to begin to have meaningful effect on large players. This particular cycle was elongated by the inversion. So we've run 3 years longer than we should have run because there was an imbalance that was to the positive side between buyers and sellers, and that was driven by the inappropriate lending that was going on in mass to what was called subprime buyers.
Well, let's not just blame the lenders, because
No, it's
I
not the
think
banks.
there was so much equity. There was just so much equity available that had to have a home. And so a lot of it was international equity, domestic equity, people who were moving money out of corporate into real estate. And that equity was driving down cap rates. And then they went to the lenders and said, well, I have to meet my return. How do I meet my return? And so, it had sort of a compounding effect. But clearly, subprime, it was.
I think what you're speaking to is what were the sources of the problem? There were multiple sources of the problem. I think what we need to step back and look at is you can't change the reality that the environment itself is filled with excess. We've had multiple years of record levels of lending, new house lending, resale lending. When you take multiple years of distribution throughout the entire market, you have a much, much bigger problem because so much of the market is at the excess level. Normal short cycles do not have that situation. This cycle has an extraordinary situation because we have extremes that have never existed before, compounded by the reality that we have a tremendous amount of bad paper created by individual buyers that were in the market, even though they were not qualified to be in the market. So they represented a large number of buyers that were literally keeping prices high when in fact there wasn't, in reality, eligible buyers to do that. Now we've gone through the immediate realization that there are far fewer available buyers. This imbalance between buyers and sellers, when there are more buyers, the cycle is a positive cycle. When there are more sellers, the cycle is a negative cycle. Through a cycle change, all lenders are impacted at different times in the cycle. So the question you've been asking, what happens with regard to condos or what happens with regard to commercial paper properties? All of this is going to be impacted by the dramatic differences that exist moment in time. Lots of people are data dependent, and for that reason they are always looking back. And you hear it all the time. Very smart people are talking about, well, the numbers don't show that we're really in a recession. The numbers don't show that things are as bad as some people are saying. Well, those are the numbers behind you. The numbers in front of you are going to show what the excesses will represent.
And I think in reality this is what has happened. People read in the press that office leasing has done so well. They forget that office leasing takes 6 months to take place.
Right.
So if they closed an office transaction 6 months ago, today it was negotiated 6 months ago. So if somebody right now is not looking for space, it's going to have an effect in 6 months to 9 months from now. And this is the situation. There was an article in the Sun that I didn't write today, talking that they analyzed, there were 10 projects, one in I think Park Slope, 2 in Harlem, 2 in Chinatown, not luxury projects, that they reduce the prices by 4 to 7% on these condos. Now, I did a segment on 1010 Wins about this, that people don't want to reduce the prices, but you know, if you pay the closing cost and you give them a $10,000 towards California closets, and you pay the broker a $2,500 fee, and you let them win a Porsche, you're doing something. You're really doing the same thing. I mean, the guys who are making money today are the New York Times, New York Magazine. You pick it up. There are more real estate ads than anything else. I mean, it's crazy.
To David's point earlier, though, I think what we're sort of doing is blending the view about what a consumer credit profile is with a commercial mortgage loan profile. And they're two different worlds, and that if you went to any of the rating agencies and went through what they perceive to be the default and delinquency experience of commercial mortgage loans, it's been relatively pristine.
You know what? That's exactly, I heard that today. The default rate is negligible. That's Joe's comment. That's the past. When these loans come up, that's the future. Now, let's talk about the future. Let's talk about lending. What are you lending on? What are you lending on today, Joe?
We typically lend on multifamily buildings. The buildings we like to lend on are buildings that are below the market, mainly because they are rent-controlled, rent-stabilized cash flows that actually operate at a level that is below an inflated market value that we all are aware is throughout this entire, region, country. There's no escaping from the fact that during the last cycle, real estate, multifamily real estate, was losing so much money that it took down banks that had been around 100 plus years. And that could easily happen again. So even though, much of the discussion about subprime is dealing with residential, individual homeowners, an evolving cycle impacts everybody. Commercial lenders are going to be impacted later in the cycle, after some of the homeowners.
I think, right now it's still go on rents, but certain people, including my own company, we may not be able to achieve this increase of rents that we think in the urban areas, because we've gone into the gentrification, and we said we can fix it up, and if that employee doesn't do it, I mean, I think I know you're into a major retail deal, which I think is a great deal, on 116th Street, but if you look at retail somewhere else, not in the urban market, I don't know how many people really, if gas goes up, people don't drive as much. There's restaurant tipping is down. There's, it's a cycle that has this effect. So, what type of loans are you doing today?
I'll generalize more broadly. I mean, when we lend, we're looking for.
Wait a second.
No,
we lend. I thought I heard you were lending.
In the past
we are
tense.
lending, but when we're lending, we're looking for the basics: great sponsorship, great asset or portfolio of assets, and then the loan structure itself. How are you priced for the risk that you're assuming?
Now I'm going to ask the big question. When you lend, do you say to a borrower today, here, okay, I underwrote the loan, it works to this certain number, I'm going to give you $30 million, you're going to lend today, we're not lending 95%, we're going to lend you 70% of cost or loan to value of this. Are you going to lend a deal? Do you have to sell the loan? Do you have to be like a syndicate to do the loan, or will you do the loan and will you hold it on your books, or do you need to make sure that you have somebody else who's going to help you participate on the loan?
I think it depends on a variety of factors. And I would echo Doug's comment. I mean, we focus on sponsorship, and so many of those sponsors have very deep-seated relationships with several financial institutions, and oftentimes when we bid on a transaction, we're bidding against B of A, Wachovia, our friends. We may have a club at the end of the deal. So
right, but that's a different case. What I'm saying is, my friends from HSH Nordbank are basically closed shop for a couple of months. A number of the other German banks have closed shop for a couple of months.
We're still open.
You're still in business, and even my friends from the Irish bank, Allied Irish, basically said, we're a little quieter today. Sponsorship is the story. I mean,
well, the rules have changed somewhat. I'd say 6 months.
But have you been rewarded for the change?
Yes.
Are you getting what you really deserve? Are you getting?
It's way overdue,
Right.
but it is changing. 6 months ago, you would get several institutions to say, "I'll underwrite this transaction myself and close post-closing, $300, $400, $500 million transaction." Still not getting paid enough. Now what you're finding is the syndication market is somewhat uncertain. People are still putting money out, but it's the end of the year. Many banks have made budget, and so several investors are saying, well, do I really need to do this transaction this year, or maybe I can do it next year? I think if you're looking at a new transaction now, it won't close this year. It won't close until 2000.
But I really have, there are office buildings selling in Manhattan today, where certain investment brokers still believe it's worth higher than it is, I mean, when are it's like the dance. When the dance stops, when are the investors who are buying these buildings going to realize that the world has changed?
When they can't get money.
And I think they have. I mean,
Yeah,
they certainly have. I mean, the brokers are doing their job. They're trying to get maximum proceeds at the lowest cost. And that's what they're supposed to do. Lenders are trying to fight back on that and provide the most profitable loan that they can arguably syndicate into
At
the
the
bank
least
loan
risk.
market.
With 1 minute left, I have a question. How long is this going to continue? I call it a credit crisis. I don't care what any of us says.
Years.
You really think it's going to be years?
Yeah.
At least 2009.
I'm probably a little bit more optimistic. I say 6, 9, 10 months.
That's the investment bankers that I heard today. They said the same thing. You know something? I think that I've really provided to my audience some really good insight onto what's happening with money for real estate. I'd like to thank David Mazugian, Doug Harmon, and Joe Ficalora. Next week, I don't know if I can even talk. I'm doing a show on residential in Brooklyn. I hope there's money to lend to these guys. Thank you. See you next week.
Major funding for these programs is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Bank of America, Murray Hill Properties, SJP Properties, Greenberg Traurig LLP. Additional funding is provided by grants from Antares Investment Partners, Arbor Realty Trust, Athena Group, BRT Realty Trust, Burden LLP, C.B. Richard Ellis, City Habitats, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, Jackson Development Group, Meridian Capital Group, McSam Hotel Group, Newmark Knight Frank, Moynihan Organization, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, Stonehenge Partners, Studley, Sutphin Properties, the Wyckoff Organization, Extreme Construction and Deconstruction.